Hello guys, welcome to my YouTube channel in which I'll teach you some basic finance tips which will help you invest better in Indian market. So in this video we are going to deep dive into investing in mutual funds SIP. So let's start. So let's take an average of a person which is investing 15,000 per month starting at the age of 25, and let's assume the average annual return which the person will be getting is 12%. And the investment period is 30 years, which is 360 months. Now, mutual funds typically give annualized returns of 10 to 12% in the long term. So, this is our basic criteria. Now, what components we have to calculate in this video? So, first is what is the total investment that you are going to do in those 30 years? What is the estimated returns, assuming average annual returns of 12%? Then, what if after 30 years you started SWP after an investment period for the next X years, for let's say for the next 15 years? So the total withdrawal in the next, let's say X years or 15 years. So what about the tax in which you are withdrawing some amount of money every month? We are going to talk about that as well. And then the remaining corpus calculation, which will be compounding at 12% average annual return, because that's the power of compounding. So all these criteria we are going to see. So let's take the case of investing 15,000 per month. So the total investment that you are going to do for the next 30 years will be 15k into 360, which is the total number of months, is equals to 54 lakhs. So you are investing 54 lakhs in those 30 years, 15,000 per month. So now this is the formula from which we are going to calculate our compounding return value. So estimated returns after 30 years will be 5 crore 29 lakhs 48,706. This is the average estimated return, which is 5.29 CR. So you are investing 54 lakhs, you are getting 5.29 CR. The next thing is, let's understanding the tax criteria. So whenever you invest in share market and if you are holding that particular amount for more than 1 year, then there will be a tax applied on that return, which is known as LTCG, which is long term capital gain, and that will be 10% on the gains that you are getting. So let's say the total principal after 30 years will be 54 lakhs. Total returns is 5.29 CR. Now, total gains will be 4.75 CR, and the gains proportion will be 89.9, or we can say 90%. And the principal proportion of that particular from that particular amount 5.29 CR is 10%. So please keep in mind that the amount that you are getting after 30 years, which is 5.29 CR, the gains proportion will be 90% and the principal proportion will be 10%. Now, let's say after 30 years at the age of 55, you start withdrawing your money. How much? Let's say you started withdrawing 5 lakhs per month for the next 15 years till the age of 70. So the first month tax calculation, how can it be calculated? Let's say the gains withdrawn. What will be the gains withdrawn? So you withdraw 5 lakhs and 90% of that 5 lakh will be your gains. So it becomes 449,500, and around 50,500 is your principal amount from that particular 5 lakh amount. Now that LTCG tax will be applied on this particular gain of 4.49 lakhs. So that will be 44,950. So on that particular month, your tax calculation is 44,950. Again in the next month you withdraw 5 lakhs, then again the tax will be applied. So let's say in the next 15 years you have withdrawn, how much total money you have withdrawn? So 5 lakhs into 180, which is 8.1 CR. So keep in mind that the total estimated returns that you will get after 30 years will be 5.29 CR. But in the next 15 years, you have withdrawn 8.1 CR, which is it's like 3 CR more. How? Well, the remaining amount keeps compounding, and that's the power of compounding. So now remaining balance compounds monthly at 1% if we take 12% annual return on average. We cannot really calculate the overall tax paid in those next 15 years because there are many rules and regulations which came every year, and let's say in the coming years this LTCG tax will be changed to 10% to 12% or whatever percent is there. So we calculate the simplified tax paid. So you have withdrawn 8.1 CR and we are calculating 10% of that LTCG tax that you are going to pay when you are withdrawing that money. So we are calculating this total simplified tax, which is 90 lakhs. So you have withdrawn 8.1 CR and you are giving away 90 lakhs as a tax. So after 15 years of withdrawal, the remaining balance continues to go with monthly compounding as well. So your final remaining balance after withdrawing 8.1 CR is still 9 CR. So if you invest monthly 15,000 at the age of 25, after 30 years, you can withdraw 8.1 CR. And after 15 years, you'll have 9 CR left. That's the power of compounding. So total amount invested 54 lakhs. Future value after 30 years is 529, 5.29 CR. Total withdrawn for the next 15 years is 8.1 CR. You have paid total tax of 90 lakhs, but still your final remaining balance is approx 9 CR. But what about inflation? To account for inflation, let's say 5% annual rate, the real value of money decreases over time. The future value of 1 rupee today in 30 years will be only 0.23 rupees. That's also the power of inflation. So you have to keep in mind that after 30 years, if you are withdrawing 5 lakhs every month, that is equal to 1 lakh rupees if we talk about today. So this is all about it. So we have calculated what is the total money we invested, what is the total amount of money we are getting after those 30 years and all those things. So that's it. So in this video, we have learned about SIP and SWP, what will be the effect of inflation that is going to have on our money, and what is the tax that we have to pay on our gains. So keep watching, keep learning, and keep investing. Jai Hind.